class we will focus on the topic of cost configuration. So we will deal with the cost configuration. One of the purposes of management accounting is to define the value of the inventories, which is also the value of the product or the services which are realized by a company. And one of the problems that we have once defining the value of the products or services is to define which are the resources that we want to assign to our final cost object. And the cost configuration allows to decide and to choose which resources we want to assign to our final cost object. And basically we can identify three different configurations of cost. The first configuration assigns to the final cost object direct costs only, which means that direct materials are assigned. So we have the direct material plus the direct labor. If we assign to our final cost object the direct material plus the direct labor, we have a configuration of cost that is defined as prime cost. A second configuration assigns to the final cost object also the manufacturing overheads. So in this case we have the prime cost plus the so-called manufacturing overhead. So the manufacturing overhead, so the typical example is the depreciation of the equipment, as in this case. So if we are assigning to our final cost object direct material, direct labor plus manufacturing overheads, we have a configuration of cost that is defined as full manufacturing cost. You can see that given that we are assigning to our final cost object direct material, direct labor and manufacturing overhead, we are calculating the production cost if we go back to the classifications of the cost. But then we have a third alternative, and I think you can imagine which is the third one, because we can also assign to our final cost object also the non-manufacturing overheads. So if we add to the full manufacturing cost also the manufacturing overheads, so basically our famous selling, general and administrative expenses, that if we can call them also as period cost. They have several names, but we are always talking about the same thing. Period cost, SGA, non-manufacturing overheads, they are the same. Basically, if we add this category of costs to the full manufacturing cost, we have a third configuration that is defined as full cost configuration. So these are the three alternatives of configurations that we can have in the moment in which we need to define the overall cost that we want to assign to our final cost object. Which is the best one? There is not a best one. We just need to take into account the trade-off in choosing either the prime cost, the full manufacturing cost, or the full cost. If we go for the prime cost configuration, we are just assigning direct costs, which means that we are adopting a configuration which is really precise, because we are assigning something which is univocally absorbed by one unit of our product. But at the same time, this configuration is not complete because we are completely avoiding manufacturing and non-manufacturing costs from our allocation to the final product. The opposite instead, if we are moving to a full costing approach. If we are adopting a full cost approach, we are basically very complete because we are assigning all of the possible resources to the final product, but we are not precise because we need in some way some approaches in order to share these general expenses among several products. Pay attention, because this distinction between full manufacturing cost and full cost is also important in terms of impact on the financial statement, and we will see this with an example. Assuming that we have this data, we have a revenue for the period which is related to the selling of some product, and this revenue is equal to 100 euros. And then we have production costs equal to 80 euros. But then we have that the 50% of the products are not sold, but they enter into the stock. And then we have period cost assuming this is marketing, for example, of 10 euros. Our problem is, can we identify the net operating income, which is a financial data? Of course, the answer is yes, and we can apply the formula that we know. So we can say revenue minus the cost of goods sold, which is the gross profit, minus the so-called selling, general and administrative expenses, also called period costs, so that we have the net operating income. If we want to calculate this, the starting point is the revenue. So the revenues is 100 euros, so we will have 100, minus the cost of goods sold. If you remember, by using Anachor logic, we need just to consider the cost of the production, given that we are just selling, actually we have 50% of the products that enter in stock, the cost of the goods sold will be just the 50% of these 80 euros, so we will have 40 euros. And then we will have 60 as a gross profit, minus the selling, general and administrative expenses, which are our period costs. You can see that our period costs are 10, so that we will have a net operating income of 50. Why this example? Because you can see that period costs enter as expense immediately within the income statement. So whatever the value, the period costs are immediately assigned as an expense within our income statement, which means that period costs are defined as non-inventoriable costs. So their impact is immediate within the income statement. This is not the case for the production costs, because the production costs, as you can see from the example, enter the income statement only in the moment in which we have the selling activity, because the remaining part enters instead the balance sheet as inventories. So basically this remaining 50% enters the balance sheet. So we can say that production costs are also defined as inventoriable costs, which means that they affect the income statement only in the moment in which we have the selling activity. And so that's the reason why it is really important in the moment in which we are selecting the cost configuration to keep in mind also the impact on of the cost configuration on the income statement. In one case, we have a direct impact on the income statement and so on the net operating income, while in the second case, we have just an impact in the moment in which we are selling. So we are inventorying some cost.